Hey, thanks for joining me today. I'm going to look at the gold chart, try and figure out where we're going to go. But first, I just want to let you know, if you're looking for a really good prop firm, I've got a recommendation for you. Fund Your FX. I like the calendar here. And most of all, I like it when you do a trade. It gives you your margin. It gives you your risk. It calculates everything for you. That I find really, really useful. But you need to know exactly how many pips you're risking, how much percentage, how much margin you're using. Anyway, have a look at it. And I do have a 15% discount, especially for my viewers today. Go into the description, click on it, get your 15% discount on this platform. Fund Your FX is an award-winning prop firm since 2021, specializing in instant funded accounts. Like, comment, and subscribe to the channel to get your chance of a free account at Fund Your FX. If you want to go straight to a larger trading account, check out the link in the description for my affiliate link for 2-phase, 1-phase, and instant funding accounts. I think you'll find it really excellent. Okay, let's get on with the gold chart. So the gold market's been in a really good bull run, as you can see. We broke above this channel, and then we had the tariff shenanigans when the market collapsed. But we've had such an incredible recovery. I'm not sure if gold's ever had a 3-day run like this. Look at this. Just wanted to show you, actually, someone's been asking me about stochastics. I get this quite a lot. How do I use the stochastic oscillator when I'm trading? And more to the point, why do I use it? I've looked at lots of different oscillators, RSI, etc. I find the slow stochastic to be the most useful. Now, one thing you've got to remember about the stochastic oscillator is when you're in a bull trend, you do not sell when the market gets overbought. And believe me, when I first started trading and I first started technical analysis, I did do that far too often, cost me a lot of money. I learned the hard way. When you're in a sideways trend, it can be a bit more helpful when the market gets overbought. So, for example, I will just show you. So when you've got a slightly more sideways trending market, it can be useful when the market gets overbought to sell. And when the market gets oversold, you can buy. Again, here we were overbought. But what you tend to find is when the market has a direction and we are moving up, the market can stay overbought or close to the overbought levels for a significant period of time. As you can see down here, you can see we tend to spend long periods of time in overbought territory, frequently there, in fact. And then, of course, because we're in a bull trend, we don't dip that much and we don't spend much time in oversold territory. But when we do get there, it's a pretty good buy indication. It's an indication that the market could bounce quite nicely. Normally, these oscillators are not great for timing, but when you use them in a decent bull trend, you don't even have to hold on to the position that long. They tend to reverse quite quickly. If you wanted to have more of a confirmation, you don't just buy when it becomes oversold. You either buy when they cross. Let me show you. Okay, there we go. So you either buy when the faster line crosses above the slower line, or you buy when they cross above the 20 line. Now, in this case, that wouldn't have worked particularly well. You'd have got a little run, but not much. In this case, you would have maybe done a bit better in the market and you would have stayed in the market for a bit longer. Experiment with it. You can decide whether you want to maybe buy into a small position when it gets oversold, add to it when it crosses, or add to it when it gets above the 20 line. There could be 3 orders within there, or you could wait for it to cross to get into your first order, maybe add to the position when it crosses above the 20 line. And of course, you can use other technical analysis techniques. So for example, if you see the market's oversold here, then you see the hammer candle, then you can decide, right, I'm going to jump in, maybe on the next candle with a stop below the low of the hammer candle. That would have been just such a perfect setup here. And then, of course, we did have a run. Now, if you managed to hold on to the position, we never got back below the hammer candle. And then eventually we did accelerate. So use a combination of patterns, use a combination of candles, formations, but the slow stochastic can work really well. You don't get loads of signals because it is a slow stochastic, but when you do get them, they're pretty reliable and they can help you stay in a trade longer. And just remember, never ever get short into a bull trend when the market gets overbought. You might want to take some profit when the market gets overbought, but it doesn't necessarily mean that the market is going to turn down. Okay, that's all I want to say on the slow stochastic. Let me know if you've got any questions, and also let me know if you have any method that you use that I haven't mentioned here that works for you on the stochastic or any of the other oscillators for that matter. Okay, so now I'm just going to look at this on the hourly chart. again, you can see when the market doesn't get oversold very often on the slow stochastic on the hourly chart, but when it does, it's usually a pretty good buying opportunity. We ticked the oversold there. Again, you know, some of the pullbacks you don't actually get anywhere near the oversold on the hourly, so it's not so useful. On the 4-hour chart, it's a little bit more useful. Although here, look, when we did bottom here, 3 times we bottomed. If you'd have bought it when we got oversold, you would have done quite well, and you wouldn't have had to hold on to the position for too long before the market did take off. Okay, enough on the oscillator. Where are we now? On the 1-hour chart in gold, we have a few very minor negative candles. I'm going to call this a bearish engulfing candle here. Not too significant because the market did take off from there and did break above it, but another bearish engulfing candle. We've got 3, and that giving me a little early warning that maybe we're just getting a little bit too overbought now. I'm not saying the market is going to turn around and collapse. I don't think that at all is going to happen. I'd have to see something on the 4-hour chart. I'd have to see something on the daily chart. But just be aware in the short term, you know, the oscillators again are showing that perhaps we're running out of momentum. So just be aware, maybe lighten up if you're long, maybe ease up on the long position so that you can be in a position to buy back in if the market does see a correction, which we might do. We've got some support around 32.20, nice little bull trend line coupled with this clear line that's showing previous support and resistance areas. So that will be the key to watch on Monday in gold. Longer term, you just go back to the daily chart. Yeah, we do have some good upward momentum. Once we broke above $31.67, of course, I'm not saying we accelerated. We were already had a lot of upward momentum, but we've certainly continued to push higher. So break above 32.45 next week will obviously signal that we are going to start another leg higher. So be prepared for that. If you're a subscriber, you've got some more support levels in the report, which was already published on Saturday. And if you're a subscriber, you've also got plenty of targets in the report for your long positions if we do break above 32.45 this week. Okay, let me know if that was helpful, and let me know if you've got any of your own opinions that I haven't mentioned today in the gold market. And if you do want to subscribe and get daily technical analysis and signals, have a look in the description box. I'll give you some links to my website where you can have a look at the services that we offer. Thanks for watching.